Hello?
Can I be heard?
You can be heard. Oh man, you're dressed up to the nines. You're looking snazzy. Hello.
Thank you. Thank you. How are you doing? I cannot see you. I can only see myself. Is this a normal thing?
I will fix that momentarily. How are you doing this fine day?
Well, I'm doing very well. Been watching soccer primarily because today we had, World Cup matches. Actually, the US played today. I don't know if you are following that in any way,
No, as an
but
American, I'm politically opposed to soccer. So I'm afraid that I've been not paying attention.
well, I
However,
mean, we call it football here,
yeah, well, if America wins, you guys have to call it soccer.
Yeah, unfortunately for you, America didn't win, so
Oh,
it's still football.
oh, that, okay. All right. That kind of sucks, but yeah, okay. All right. I'm not mad. Hi.
How are you doing?
I'm doing good. Actually, I feel like shit. I I overslept. I had an alarm set for 9, which I woke up to. I wanted a bit more time, so I set it for 9:30 because stream starts at 11. And then I woke up at 11:37. The only reason I showed up for stream at all today, was because of you. So chat can thank you for that. If I didn't have an appointment, then I definitely would have just called in sick or faked a car accident or something.
Well, I mean, I feel, you are giving me a lot of praise right now. But in any way, I think it's going to be worth it. I think our conversation today can certainly, pay off for the effort that you are exerting with this.
Yeah, I'm
But
sorry I took
in
so
any
long
way,
to get back to you, by the way.
oh,
I
yeah,
know it's,
that's actually,
yeah.
yeah, yeah. I mean, I mean, people don't know, but we've been exchanging emails since 2019, probably.
Yeah, it's been a little while.
I was a sophomore in college, and now I'm already, like graduated. I have master's degree. I am working, so it's been a long time.
Yeah, we're just we're finally capitalizing. It's like fermentation, okay? We're getting the best product. Well, I apologize. Please do not say don't see it as a sign of disrespect. I'm actually just very, very bad at managing my affairs. But it's a delight to speak to you now. Please introduce yourself. Your name, your measures of interest, your pronouns, everything you prefer, and we'll get right to it.
Okay. Well, my name is Victor Magariña. My pronouns are he, him. And well, I am an economist. I have my bachelor's degree in economics from NYU, and I also studied there philosophy. I also have a master's degree in economics, and I'm working toward an MBA. And I'm currently working in the behavioral economics department at one of the biggest, one of the largest banks in the world called BBVA. And actually, we have probably the best, behavioral economics team in the financial sector worldwide. So I'm really happy to be here. Again, it's been a long time since the first time we spoke, so this introduction would have been a lot different back then. But yeah, I mean, that's what I do. And I also have a YouTube channel where I discuss classical political economy, Marxian political economy. And I do consider myself as an economist that belongs to that tradition of economic thinking.
Yeah,
So,
that's why this took so long. I was waiting for that introduction to ferment, A couple more years and we could have gotten you in as,
exactly.
like a partner with this firm or whatever. But yeah, you have to draw it in somewhere. So, keeping in line with me being forthcoming about my failures, it's been so long that I've honestly just plumb forgot everything we were supposed to talk about. So remind me, did I do something wrong?
Well, I mean, so what happened was that you talked to one person about the labor theory of value. And
Oh dear.
at that time, I watched that conversation and I thought, well, I mean, there are some things here that certainly can be improved upon, at the very least. And so I decided to make a video where I commented on those things. And certainly there are many more things that I wanted to comment. And so what I said is, look, let me just talk to the guy himself and let's just figure things out, live so that we can get a more productive conversation than if just like making
Yeah.
a video or whatever.
Okay, so yeah, all right, let's kick right to it then. I
Mhm.
am okay. I'm more of a sociology guy than an economics guy. I think you can make a lot of really compelling arguments for socialism based on sociological theory, you know? I don't tend to touch on the econ stuff that much, and as a result of that, the line that I tend to push when I'm talking about, like, what economic changes I want to see is usually market socialism. Because market socialism is the furthest you can go without fundamental reorganization of the economy. It's the most you can achieve those principles without having to make big leaps in terms of like, well, what could you do to maintain like a stable global economy without this or without that, without decommodification or whatever. I do have I guess interest in what goes beyond that, but I know that beyond that territory, you know, we get into stuff that I would have to make like very, very tenuous like judgments on. When it comes to stuff like the labor theory of value, I usually try like kind of wave this off, not because I don't think there's value there, but because I feel like whenever the subject comes up, everyone has a different definition of the labor theory of value and therefore a different set of counter arguments against it. And even like touching on that territory, it like sets you up for so much scrutiny. I try to stick to the stuff that I feel is the most defensible. So I would love to get like any like broader info on the on the harder stuff, you know?
Yeah, I mean, so let me just say before, getting into the details and whatever, uh, it is really important, okay, to have a good understanding of a lot of these economic theories that we're going to be talking about, because they inform a lot of the uh, more developed, more analytically developed positions that you can take on stuff like politics, sociology, and stuff. Economics gives you an understanding of the mechanisms of the functioning of that of the material realm of society, and from that material realm of society emerge a lot of the stuff that are then interesting in in political sciences, in sociology and stuff. So I think that it's always good to at least have a good background knowledge on economics and on this subject. But of course, economics is, well, I mean, it's a science that has been touched from many different angles. It is a science that has a lot of contentions within it. It is certainly not a solved science in the sense that there is consensus. Actually, I would say that there's not even consensus on the definition of economics to begin with. So right. Yeah, so that's the level that we are working at. But at the same time, okay, there's a lot of value in these kinds of debates and in these kinds of conversations. And one of the main themes, okay, starting from my school of economic thinking, one of the main things that we need to understand in order to make sense of the world that we live in, and in order to make changes in that world, okay, is the law of value. Okay, it's value and wealth, and what is exactly economic value, and that is one of the things that I feel that it's lacking in a lot of leftist discourse, proper understanding of this question. And look, I don't think that I have the answers to everything. Of course, I don't, but I think that I have at least some understanding that can be helpful. So if you want, we can touch on this particular subject to begin with, and then if we have time, we can go on other stuff, because there's certainly so much stuff that I wanted to talk about that we're certainly not going to have enough time, because I wanted to talk about unemployment, inequality, international trade, economic crisis, things that I've heard you talk about a little bit.
We might have a decent measure of time here. Yeah, I just the value theory stuff is really difficult for me to grasp. I tried to. I've watched YouTube videos that have been recommended to me, and I've looked at a couple of papers on labor theory of value and stuff. I know that value and price aren't the same thing. You can argue that in a capitalist system, there's an incentive towards price being marked at the point where people are willing to pay the highest amount for something at the the level set by the person selling the item, and so on and so forth. And value seems to be more of like a subjective philosophical thing of like, well, what does this actually represent? Like what by what criteria should we actually determine the value of this? But I don't know how much that even tracks economically between price and value, because it seems like every time I hear this, it's like, okay, well, actually, value is a totally separate thing. So my question would be, how is it even economic then? Wouldn't it be more of like a philosophical judgment?
So look, so we should start actually with the question of what is wealth. before we get into value, okay? Because I think that it's going to clarify a lot of the background that surrounds the question of value, and it's going to make it a lot easier to see the point that I want to make. But before going there, I wanted to ask you this. What is your understanding of the labor theory of value? And actually, not only what is your understanding of the labor theory of value, but what theory of value do you work with? What is the theory of value that you believe is the most accurate? So that we have, so that I can have also an understanding of what you believe.
My understanding of the labor theory of value is that, for one, labor and price don't directly correlate. So a lot of people say that it's supposed to, but it doesn't. And that the value of an item is determined by the amount of human labor that's put into its creation. So you could, as a separate analysis of price, you could say, like, the value of an item is determined by, like, well, how many work hours does it take to produce? What's the total sum of human effort involved in the creation of this product? And that it's that measure which determines, like, the increase in value of an item, So you can dig, like, you can get some dirt or some clay from the ground, but it's value that transforms that into the pot. Diamonds may exist beneath the earth, but it's labor that brings them to the surface and cuts them and puts them in a ring facet, stuff like that. But as for what value assessment I have, I don't really think that I have one, because it seems like such an arbitrary. I like thinking of things from the labor perspective because I think it encourages thinking about things the right way, Like, I think it motivates good analysis to think of it from a labor-centric perspective, but I don't have any, like, hard and fast rules when it comes to it.
Okay, so you're open to so you're certainly open to having, like, to being, a strict defender of the labor theory of value if you are convinced of its theoretical and empirical validity, right?
If I can be convinced of its value, yes, then I'll defend its value. I know some people try to push this as some, like, determinist, like, material law of the universe, which I know a lot of people, especially those people who will say that Marxism-Leninism is like a science or whatever. I know those people are crazy. So there's still versions of this I can't stand behind. But if there's value there, then yeah.
Okay, well then let's make it my job today to convince you of this, okay, of the scientific validity of the labor theory of value and its implications for political reasoning. Okay, let's make this the goal. Okay, so why don't we start with wealth? Okay, the question is, what is wealth? Okay, what is wealth? What do you regard as wealth?
The sum of items possessed which are determined to be valuable, like, sort of socially. So you wouldn't consider a giant dirt pile to be a source of wealth unless you lived in a society where a giant dirt pile was incredibly valuable. So it has to be tied towards, like, subjective analysis of value.
Okay. Well, that's certainly part of the story. Actually, I think that's not a good beginning definition of wealth, because normally you hear a lot of people going into these poetic rants about how wealth is about having intelligent people surrounding you, about having a lot of productive people, defining production in a way that is not really scientific, in my opinion. And if you think about it, it doesn't make sense, right? Because okay, take the most intelligent, hardworking, and smartest people in the world. People like Elon Musk, Kanye West, people like Donald Trump. Take them and put them, okay, in the middle of a desert.
Oh, please.
Well, clearly they are not going to be the wealthy. Clearly, you will not say these are wealthy people. So obviously, wealth cannot be about this being smart, having a lot of these properties, or even having loved ones around you. Okay, that is clearly so. From a scientific perspective, what we want to talk about is what you said. It's stuff. Okay, wealth clearly refers to stuff. To things that not only to things, but also to things that satisfy human needs and wants. Okay, so that is pretty much what has been the case for the entire, for the entire human history. Wealth has been comprised primarily in all societies by the amount of objects of social use. Okay, this is the way that we call it in Marxian political economy: objects of social use or use values that society has possession over. Okay, or that has available to it. So that is primarily what constitutes wealth in all societies. But the question is, Well, I mean, yes, the objects of social use, okay, are what comprise wealth. But depending on the society that you are in, that wealth can take one form or another. And this form is a pure social construct, okay?
Yeah, like
Because
right now, like having a bunch of water in your bathtub wouldn't really be a measure of wealth. But in the post-apocalypse, having a bunch of water, clean, drinkable water, would actually be like enormously powerful, and people would trade a lot for that. So it has
and
to be like measured by human needs and what. There can't be an empirical or like flat analysis of that, right?
yeah, for sure. And not only that, but a hammer, okay, today serves the same purpose than a hammer, 100, 200, 500 years ago. But a hammer today is not the same object. Okay, it's the same object as far as its material properties are concerned. But as far as its social properties are concerned, it's not the same thing, because a hammer today, okay, serves a role as part of the circuit of capital, which is specific to capitalist societies. Whereas before it served as, a tool used, I don't know, let's say by a worker in a feudal society within the social context, within the economic context of feudal societies. So in capitalist societies, wealth exists, but it doesn't take the same form as in other societies. In capitalist societies, and this is how Marx starts Capital, with this phrase, a phrase that goes like this: the commodity is the unit of wealth of capitalist societies, and the wealth of capitalist societies presents to us as a massive, pile of commodities. That is what wealth is. And that is what constitutes the wealth of capitalist societies, is commodities. And commodities are specific to capitalist societies. Commodities are objects that are outside of us, that satisfy human needs and wants, okay? And that is insofar as we consider them objects of social use. But not only are they are objects that can be exchanged for other objects. And it is only in capitalist societies where this property is generalized and it's made socially relevant and prevalent, okay? And this is why commodities are the specific form that wealth takes in capitalist societies, whereas before it didn't.
No, I understand that. I mean, it's distinct from mercantilism as well, right? Because the kingdoms of Europe were very wealthy in the sense that they accumulated a lot of precious gems and gold and silver and what have you. But the wealth didn't represent like the potential exchange into commodity value. Like kingdoms weren't holding on to that wealth as an implied measure of their ability to buy whatever, except for maybe ships and armies. But that had more to do with like colonial expansion than it did like commodity purchasing. And it's not really a commodity if you buy a ship that you build for your army, I think, because you're not really opening that to the market. You're doing that for a specific purpose. Whereas now, like all wealth is kind of contextualized in its ability to be transferred into commodity ownership, right?
Exactly. No, I mean, you put it in a very nice manner. I think that really what we want. So, okay, so we start from the premise that in capitalist societies, wealth takes the form of commodities, and commodities have this property of being exchangeable, of being commensurable. So then one key question is, how can these types of societies exist? Okay, how can they exist? How do they work? And what regulates the proportion with which commodities exchange in the market? Because wealth is not just about having a lot of stuff, a lot of commodities, but it's also about having commodities that are valuable, okay? Because, yeah, maybe you have a lot of sand, and yeah, that sand probably has, let's say, a price to it, and maybe you have $100 worth of sand, but $100 worth of 1 kilogram of sand, I mean, that's a really high amount of dollars for 1 kilogram of sand. But let's imagine it's not the same as 1 kilogram of iPhones. Okay, 1 kilogram of iPhones is probably more valuable than a kilogram of sand. So then the question is, why? Why is this the case? So why is a kilogram of iPhones more valuable than a kilogram of sand?
Well, it serves
and what basically
case, right?
What? Sorry.
Oh, well, there are two ways you could go about that, right? It's either because it took more human effort to produce, or because it serves greater purpose to those who could use it.
Well, okay. So there are two ways of going about that, but really the first one that you said encompasses the second. Let me explain why. So, as I was saying, in the definition of what a commodity is the fact that it has to satisfy human needs and wants. Okay, so it needs to be useful. So we already start from the premise that in order for something to be valuable, it must have a use value. It must be useful. So then after that, okay, we go with another question, which is, okay, but is it the usefulness of things? Is that what regulates the proportions with which commodities exchange in the market? Is it the determining factor, okay, of that social phenomena that we observe in the market where things get exchanged and they have a specific proportion? Well, my contention is that it is not. Okay, it is a factor that certainly influences, okay, these types of exchanges, but it is not the determining factor. And let me give you an example as to why I believe this is the case. So take a very simple exchange, okay, where you have, let's take again a kilogram of sand, okay, and a kilogram of apples. Okay, and you see that in the market, let's say that they have the same price, $10. So you exchange one for the other, and the proportion with which you exchange one for the other is a 1-to-1 proportion, right?
Yeah.
So you have producer A, which has the sand, and you have producer B, which has the apples, okay, and the exchange. Now, theoretically, the reason why this exchange took place is because the person that had the sand wanted the apples, so they found more use value in the apples, and the guy that had the apples found more use value in more utility in the sand. So when the exchange occurs, both gain in utility, right? Both gain in utility because now they have something that is more valuable to them than the thing that they had before. So utility, aggregate utility has increased.
Well, this is the ideal capitalist exchange, right? The idea would be that there are no it's not a static system or like net zero value, that every exchange ideally would represent a gain in perceived value for both sides.
Yes, this is the canonical exchange. Okay, and within this exchange, notice that aggregate utility has increased, but exchange value hasn't, because both commodities are still worth the same, are still worth $10. So there's no increase or a decrease in aggregate, purchasing power. Nevertheless, there is an increase in utility. So one thing cannot explain the other because one moves in one way and the other doesn't move. So if there is no correlation of this kind, clearly this cannot be these are things of different orders. So clearly they cannot explain each other, right?
Yeah.
Now, then, okay, what we want to answer is, okay, then what do these commodities have in common that is common to all of them? That is quantifiable because exchange value is quantifiable itself. So something that they all have in common that is quantifiable and that is, a social property of these commodities, because these exchanges don't occur in an isolated room. They occur in society. So what is something that satisfies all of these three criteria?
Well, I mean, any exchange potentially could, right? Depending on how it's handled. You mean like what theory would?
No, I mean what substance, what thing, okay, satisfies the three criteria that I outlined, okay, of something that is quantifiable, that is a social property of commodities, and at the same time, okay, something that all of them have in common.
Well, it'd be value to the extent that it is quantifiable, right?
Yes, exactly. It would be value. And you know what we call value in my tradition of economic thinking? Socially necessary, direct and indirect labor time. That is value. Okay, and that is exactly the social property that all of these commodities have in common, that is quantifiable, okay, and that they represent a greater or a lesser magnitude of.
Okay, and I fully understand that.
Yeah.
No, I fully understand that, like as an analytical framework. The obvious counterexamples that I hear, or maybe they're not counterexamples at all, but the obvious, like, I guess, retorts that I hear are like, well, what about all the examples of things that are enormously valued despite having like very little human labor put into their production? People have sentimental value for stuff that they're like nostalgic for example, and that can be tied into to something that's sort of extrinsic to the production of any given commodity, having a pet rock or whatever. And there are also like social fads or bubbles, right? Where you spend a lot of money on promotional stuff, but not so much in the construction of any individual commodity. So it's valued highly despite it itself not being, representing much labor in construction.
I notice that the marketing that goes into commodities, into selling commodities, also adds value to those commodities in the sense that it is part of the deal. Okay, a lot of the times when you're buying something, you're not just buying the thing. In capital societies, you're buying all of the context that surrounds that thing, and there's productive labor that goes into that, into producing the environment in which you consume that particular object. So that makes the object more valuable because there is more effort put into them creating the right environment for you to consume that particular object.
So you would argue
So,
that would encompass nostalgia as well. Even if there was something that somebody valued enormously because it was like like some childhood pet or like plushie or whatever, the value there is a product of the human emotional investment. That there is no like value assessment exigent to what humans create for it. It's all a product of what gets put in.
okay. Let's phrase this from a
It's like
different
emotional
perspective.
labor,
So
kind of.
what I'm doing is I'm trying to explain, okay, again, the proportion with which these commodities exchange in the market, okay, what makes one thing be much more quantitatively valuable than another, quantitatively in the sense that its price is a lot higher, okay, and obviously, okay, we have emotional attachments to objects, and certainly some objects in general society, they are considered as very, as having a lot of prestige, like, very expensive paintings and all of that, and that makes, certainly that has an effect on the price of those particular objects. And certainly, okay, there are counterexamples where you would say, okay, what about let's say a Van Gogh painting, okay, that is worth millions of dollars, and nevertheless there's not that much labor put into it. There's not enough labor to justify the price that it has. And my reply, and the reply that has been made in Marxian political economy throughout history, and actually Marx himself presented this, is okay, yes, there are certainly counterexamples, but what we are trying to explain here is a social phenomenon. Okay, we're trying to explain a social phenomenon, and we cannot explain social phenomena by appealing to individual isolated cases. This is, a very small part of the economy. Most of the exchanges that take place are not, very, very overpriced paintings. Okay, that is a very small part of the story. So clearly, we can explain those things by saying, okay, obviously, the law of value doesn't apply to the pricing of those particular objects, but it's not because the law of value doesn't apply to general society, but just because it cannot get to those specific cases where it is not meant to get. Okay? So, because those specific cases don't follow the same laws.
So by law then, because when I hear law, I tend to think scientific law, like gravitational, whatever. By law, you mean the same kind of economic law of like the law of like supply and demand or whatever. We're talking about things that broadly describe tendencies. They're laws in the sense that norms average out towards them. They're laws in the sense that they broadly describe human behavior, not that they're universally applicable down to the decimal point in all cases. We're talking about law, yeah, as like an analytical or predictive system more so than a mathematical guarantee.
Exactly, yeah, and not just that. It's that under a specific set of conditions, this is what we expect to take place. But you know that the very expensive painting doesn't meet those conditions because it is, first of all, not reproducible. And one of the conditions for the law of value to apply is that the object, the commodity, needs to be reproducible. And it needs to be reproducible because it is competition, and this is one of the themes that I wanted to talk about. Competition is really the driving factor of the outcome that we describe in the labor theory of value of relative prices of commodities being regulated by the relative labor times that went into the production of those commodities.
Okay, I understand that. So I guess then like my follow-up would be like, in what way is this understanding useful? I can understand this as being useful in like a sociological sense or kind of like in an advocacy sense. Like if you perceive all value to be a product of labor, it necessarily gets you more like labor oriented when you're talking about analysis or like economic predictions. I get that. But would you then use this if you're suggesting we would use this sort of predictively, like what will the price of an object end up being? Um, I don't know if I've ever seen it applied that way, but if it's not being applied that way, then we need not even tie this to price, right? It can just be like an abstract analytical thing.
Notice that price is just a label on objects that tells you basically, is the thing that tells you how much, how many other commodities does the commodity that you have command. Okay, so if you have something that is worth $100, you know that in the market, if you sell that, you're going to be able to command $100 worth of all other commodities, whatever commodities you want to purchase. So really, the thing that we're interested here in is really relative prices, not just prices, but relative prices. Relative in the sense that you take the ratio of these prices, and what the ratio tells you is exactly what I was talking about, the proportion with which commodities exchange. If one commodity is worth $2, another is worth 1, okay, you take the ratio and you get 2, okay, 2 over 1 is 2, so you know that one commodity, okay, is worth twice the other. So this proportion is really what we're interested in. And what we want to predict is relative prices and movements in relative prices. And the labor theory of value here comes with 3 main hypotheses, okay, that have been empirically tested. And this is why, responding to your answer, is this useful? Well, it is certainly useful. And let me tell you one of the implications that it has, okay, which is exploitation. Okay, the theory of exploitation relies on this understanding of value. Although you can derive other theories of exploitation that don't necessarily follow, the labor theory of value, but the one that Marx develops is premised upon the labor theory of value, and I would say it's the more robust and the more scientific one of these theories, which has also been tested. But the 3 main hypotheses, okay, that the labor theory of value produces at this level is, first of all, a cross-sectional hypothesis, second of all, a time series hypothesis, and third of all, a structural hypothesis. Okay, and this has a lot of algebraic formulation behind it. Okay, you can go to my channel and read my thesis if you're interested. But okay, from a very a simplified perspective, all of these predictions have been met with empirical success. So the data has shown all of these predictions to be accurate in reflecting the reality of capitalist societies. Okay, but okay, so
okay, I get that. I if ever I were to speak on subjects like this, I would keep a light touch because it's not my field of study, economics. If there's, I'm looking. I guess so. From my perspective, right, being a not economist, I'm looking more towards like if somebody comes at this, let's say somebody's smearing the good name of Marx, my guy, a couple of quips, the value of this or that, the usefulness of this theory or the other, where is it useful? That's because that's what I'm interested in primarily. I'm not going to make these predictions myself. That's out of my field. So this is what I want to hit on, I know that at the end of the day, when we talk about economic laws and frameworks, we're talking about ways of understanding the world, like predictive systems that we can use to kind of get an angle on, maybe a bit of prediction, a little bit of analysis. Nothing hard and fast ever, not in any kind of social science, at least, as far as I can tell. More of like a broader angle from which to take things, and I can get that, even if I don't understand like the direct applicability. I want to know, like, how is any of this useful in terms of like why would a person choose to use these theories for predictive purposes?
Well, first of all, if value is determined by the amount of socially necessary labor time that goes into the production of commodities, that means the following thing, that when the capitalist makes an investment, the capitalist is purchasing commodities that have a solidified value in them, and then he mixes that with productive and unproductive labor to create a final product that then he sells at a profit. And the question is, what explains this particular profit? Because the capitalist, under the very simple analytical framework that we were working with, where commodities exchange at their values, from this analytical framework, which is the more simplified one, the capitalist is exchanging the final product for exactly what it's worth. Exactly what it's worth, right? Which is the amount of socially necessary labor time that goes into the production of that particular product that they have produced. So then the question is, where does profit come from then? If the capitalist is selling things exactly at what they're worth, where does the profit come from? And what Marx would say, which is what he developed from the classical political economists, is, well, he earns profit from the fact that when he purchased the raw materials, okay, and when he combined those with production labor, he extended the amount of labor that those workers do, that those workers had to do, beyond what was needed for their own reproduction. And they added more value into the final product than what they got back. And it is from that material basis where you can explain the profit that the capitalist earned. And that is very useful because if you tie monetary profits to the amount of labor time that goes into the production of commodities, then you get, a theory that can explain monetary phenomena, monetary categories from a more basic, okay, from a more material substance. And this at the same time can tell you a lot about unemployment, about inequality, about economic crisis. Okay, and there are many predictions that come after that.
So this I don't necessarily track. The labor is extended. In what way? It seems like, if anything, the automotive or the automatic forces of like modern production mean that an incredibly small amount of individual worker labor can go into the production of something that would have taken an enormous amount of time and effort before. Where is this excess labor coming from?
Yeah. So notice first of all that productivity is so productivity normally is referred to as the amount of a given product that you can produce within a given time frame. Normally an hour, or normally if you're looking at aggregate, at macroeconomic statistics, normally productivity is measured, like in terms of hours or in terms of years, the amount of output that you produce in a year. And productivity can certainly increase with technological development. In fact, this is one of the main things about capitalist economies, which is that they have been able to increase productivity massively in comparison to what previous societies had done. And this is one of the questions that Marx was dealing with. Okay, why is it that capitalist societies are so productive? And the reason is because they are very good at what you just said, cutting the amount of labor per unit that goes into the production of the commodities. Okay, they cut it, okay, with technological development, and what that means is that the commodity is cheaper, and by being cheaper, they can sell it at a lower price. Because again, we were saying that value is what regulates, what determines the proportions with which commodities exchange in the market. So if something contains less value per unit, it means that you can sell it at a lower value per unit, at a lower price per unit. And what this does is it produces a competitive advantage over your competitors. And what this makes is, your business more likely to succeed within the environment of capitalist competition. It's a little bit like natural selection, where you would have an environment of, in the sense of natural selection, you have animals, you have, beings that are competing in a space to reproduce, okay, to pass on their genes to the future generations. And within a given set of environment, within that environment, there are certain laws that regulate which kinds of individuals reproduce and which don't. But in capitalist societies, it's the same. Within the marketplace, within the environment of market competition, there are some laws that determine whether some people succeed and where some people don't. And where are those laws? The laws of profitability. And one of those laws is that generally, if your business is not profitable, it's sooner or later going to go out of business. And what that makes you is, a person that exits the market and leaves place only for the people that were able to survive. And those people, if they survived by cutting costs and cutting their prices, then they are able to sell cheaper. The market, therefore, has a unit price cheaper than it had before. And again, this is due to productivity. This is due to an increase in productivity, generally because of technical innovation. But that's not the only way that productivity can be extended. Okay, there's this notion of relative and absolute surplus value. One way that you can do it is by, for example, extending the working day, making people work more, or extending the intensity of the working day. Okay, making people work more intensively than before.
But it seems to me like in these cases, the rate of profit and the rate of exploitation is increasing with a relative decrease in the amount of work that a worker is expected to do, right? Like the profit margins of many industries have increased since the beginning of the 20th century, in spite of the fact that worker rights have improved since then, and therefore, in like a at least in like a socially relevant sense, worker exploitation is lower than it was back in the early 20th century. You know, since then we have like weekends and overtime laws and stuff like that. So is it just there's like a wall between socially experienced exploitation and exploitation in the Marxian sense, which refers exclusively to surplus labor? Or we're relegating this sort of entirely to like the economics of the situation, not necessarily lived experience?
Well, there is certainly a link, okay? Profitability is linked to exploitation in the sense that the exploitation is, so if you look at the rate of profit, okay, the analytical rate of profit is just, okay, this algebraic ratio of surplus value to the sum of the value that represents the inputs, which is constant capital plus variable capital, okay? That ratio is the rate of profit. Now, if you notice this, the rate of profit is a function, a positive function of the rate of exploitation, which is the ratio of surplus value to variable capital, right? Because if you just divide by the denominator and the numerator variable capital, you will see that you would get in the numerator the rate of surplus value, and it is a positive function, okay, of the rate of profit. Vice versa, the rate of profit is a positive function of the rate of exploitation. So the prediction is, okay, the higher the profit rate, that means not necessarily, because there's also the denominator, which you also have to take into consideration. But you know, ceteris paribus, you know what we say, ceteris paribus, the rate of profit will move upward if the rate of exploitation moves upward, and this is a prediction, and this is a hypothesis of the theory, and this has been tested empirically, and the empirical tests show that this is accurate. Okay, that in the time, for example, in the Reagan time in the U.S., where you see, you know, a lot of the diminishment of the power of the working class that had been built up before that period, you see that there's suddenly a high rise in the rate of exploitation, and suddenly a huge rise in the rate of profit. Okay, which is met by a huge decline in the wage share. Okay,
so we're
in the
talking,
share of total output that goes to labor.
So critically, we're talking about relative metrics here. It's kind of like how wealth inequality now is worse than it was 100 years ago, even though the lives of the poor are better now than they were 100 years ago. In the same way that exploitation positively correlates with excess profit, you know, that doesn't necessarily mean they both increase by the same metric over time. With things being more efficient now than they were back then, and higher worker rates of worker compensation now than back then, at least relatively speaking, even if workers are less exploited on a baseline, their exploitation still correlates to the amount of surplus capital or surplus profit, which I agree with. That makes sense. Yeah, there isn't really like a system anywhere in the world where there's a monetary structure for which corporations benefit from exploiting their workers less. Like it always, there's always a trend upwards, even if the floor rises.
But notice that within this framework, okay, you already pointed to you already answered your question of why is this useful. Within the framework that I just laid out to you, which is the framework of classical and Marxian political economy, we suddenly are able to make sense of phenomena like the rise in profitability and the decline of the wage share in the period during the Reagan era and afterwards. Suddenly we can make sense of that type of phenomena, whereas if you look at other economic schools of thought, you will see that they don't make sense of this. They don't make sense of it, and if they try, they make some weird theories, or a lot of the time they don't even look at it. They don't even ask themselves, look, suddenly there's a huge rise in the rate of profit after this era, and a huge decline in the wage share. Why is this the case? Some people would tell you, well, it's because capital is now more productive, and the share of total output that goes to that goes to the capitalist is, determined by the marginal productivity of capital, and that has been going up. But you know what? So this is a very interesting thing, that in neoclassical economics, okay, first of all, aggregate production functions, okay, have been criticized from all the places, and they have been basically shown to be non-existent or actually bad theoretical tools. Okay, aggregate production functions don't really work, and there are countless
What do you mean
works
by aggregate production functions?
So production functions are this notion that is developed in neoclassical economics, that basically is a function that where the dependent variable is output, and the independent variables are normally the inputs that go into production, which are capital and labor, right? And normally what these production functions do is they tell you, okay, what from a given combination of inputs, what is the output that you expect to obtain. So for example, if your aggregate, if your production, normally aggregate production functions generally take the Cobb-Douglas form, okay, which is one form that is really simple analytically, and that also, makes gives you the ideological outcome of, well, the share of output that goes to capitalists is equal to the marginal productivity of capital and all that. So aggregate production functions, for example, you can have one that is very simple, which is just output is equal to labor plus capital. So if you have 1 unit of labor and 1 unit of capital, what is your output? 2. And then you get the question, how do you measure these units? And this is an entire, this is a very complicated issue, okay? And especially with regards to capital, there's this thing that was, very prevalent during the 60s, especially, which is the Cambridge capital controversies, okay? Which is a debate between neoclassical and Schraffian, classical political economists, and in general, heterodox economists, where they debated particularly on this question, okay? On the nature of capital, on how can you build aggregate measures of capital? What does it make sense to have, this notion of aggregate production functions and all of that? And the answer really was that all of these things that today are still used in neoclassical economics don't really make sense. What happened? That the people that won that debate, which were the people that were arguing against neoclassical economics, suddenly got quieter, okay? So suddenly the people stopped looking at that particular issue, and they just kept forward with the theoretical tools that had been shown to be not accurate, that had been shown to be very bad reflections of the world. And this is one of the reasons why, okay, neoclassical economists have been, criticized so much, and this is why you have a lot of the resurgence of post-Keynesian economics and a lot of economic schools that try to diverge a little bit from that, okay, from that standpoint. But this is an entirely different subject. The important thing is, within the framework that I laid out to you, we can make sense of economic phenomena that actually are relevant for political discourse as well, okay? Because I would argue that the decline of the wage share of the working class is, certainly a subject that touches on a lot of political discussions. And not only that, but we can actually make predictions on other stuff as well that are also very useful.
So to scale it back, you're telling me that there's no neoclassical explanation for the wage share decreasing for the working class as productivity increases, that the neoliberal or the neoclassical economic framework would argue that as productivity increases, that shouldn't have any impact at all on the wage share. It should be like a neutral variable when it comes to the proportion of wealth that goes to the wealthy versus the workers?
No. I mean, not in that way. Okay, so the thing is, neoclassical economics obviously has some explanations of these phenomena as well, but the thing is that they are built, okay, from the standpoint of tools that have been shown algebraically, not only just like from a conceptual standpoint, but also from like a purely mathematical standpoint. They have been shown to not be correct, and what they do is they take those and they take a lot of assumptions and that are really unsupported, and what they do is they explain that phenomena by just like fitting the data into their pre-existing model that has been shown to be incorrect. So it's not an actual explanation, because when you just say, okay, productivity has risen in this period, and this is why the profit share has been rising. Okay, what you're just doing is you're just equating, okay, a higher productivity with that increase in the profit share. But by doing that, you're just like saying, it's just like saying, why are capitalists more wealthy now? Because they're more productive. But wait, I mean, they don't produce anything. Okay, capitalists are really not production. Capitalist labor is non-production labor. So then, how can you say this? Well, I say this because I equate being more wealthy with being more productive. You know what I mean?
So yeah, you're saying that framing it that way makes the argument for them. But under a labor theory of value perspective, the connection would be drawn how then? What like line would it draw that would frame things correctly for that particular relationship?
The line is the following. The line is that because of the loss of political and economic power of the working class during that period, the capitalists were able to obtain a larger part of the share of output, not because they were more productive or because magic, but because they had the political advantage to do so, to get that extra surplus, and they did so. And the workers, because
I fully agree with that. But what does that have to do with the labor theory of value? Because that argument can be made extrinsic to any like objective analysis of the value of commodities.
Well, it has to do on the fact that the labor theory of value says, okay, so the labor theory of value says that it is a higher rate of exploitation in the sense of in value terms that explains these higher monetary profits. Okay, and if you look at those two things empirically and you see that exactly the two things move in the same direction in the right proportion, then you are basically explaining that rise in monetary profits by the rise in the rate of exploitation defined in value terms, in the value terms of socially necessary direct and indirect labor time.
But isn't the labor time decreasing for any individual commodity because of the increased efficiency with which they can be produced?
Yeah, but the profit rate is not. So the profit rate is not concerned with the. So okay, the profit rate is not just about how much does one commodity cost. Okay, one commodity is sold at. It's about what is the per unit cost and what is the per unit price that you're obtaining. So in this sense, what you have is the following. So you have that the rate of exploitation has been rising. Okay. And the organic composition of capital, which is the part in the denominator, has been more or less constant, okay, without that really big shift. So what you have is an increase in the rate of profit, because as I was saying before, the rate of profit is a function, a positive function of the rate of exploitation, right? So that is the prediction that we make, and that is exactly what we observe.
So the proportion in between the necessary labor put into the production of a unit versus the amount that it's valued at and sold for, but as a ratio between the two, meaning that the rate of profit would have increased if originally like it took $1 to make a can of soda, but it was sold at $2. But if you decreased it to it taking 1 cent to make a can of soda, but selling it at 5 cents, that would be a significant increase in the rate of profit, even if the absolute values had decreased, because proportionally you were making a greater profit on any individual unit relative to its production cost, right? This is a relative metric.
Exactly, it's a relative metric, and not only that, but you're touching on something that is also part of the story, which is what we call the tendency of the rate of profit to fall.
Yeah, I was going to ask about that because I keep hearing about that, and I don't know what it means.
And this comes exactly from the intuition, okay, the algebraic intuition that, wait, I mean, technical innovation, okay, implies a lower per unit cost, okay? And normally technical innovation comes, okay, with a greater amount of constant capital employed in production. So what this means is that the part in the denominator of the rate of profit, okay, in the part in the denominator, is slowly going to rise. Okay, there's going to be an increase in that is driven by technical innovation. So if this is the case and the denominator rises, this pushes downward the rate of profit. Okay, and if the rate of surplus value doesn't catch up, then the rate of profit is going to slowly decline.
So it's
and
kind
this
of
is
like,
okay.
meet me where I'm at. Meet me where my small brain is at, okay? I like video games. Back when video games were sold in the 1990s, it cost $60 to buy a video game, a Nintendo 64 cartridge. Nowadays, AAA video games take way more to produce in terms of the effort, labor invested in their production, way more time, way more money. They're still sold at $60. This is in spite of the fact that $60 now is worth like half what it was 30 years ago. So would this be an example of the consumer has grown used to $60 as at the price point for a video game, but has higher expectations due to technological developments and such for what it means to make a game. Therefore, we're actually seeing like the rate of profit is falling simply because we see this with streaming services too, right? Where a bunch of Netflix shows get made and then get canceled. Even though these are high production shows that get a lot of like views, the actual like per episode watched margin is really low in terms of like profit for any given show that's watched, which means that like even though these shows cost a lot to produce, the consumer has gotten used to a model where we can consume them for cheaper. Would these be examples of the rate of profit falling over time?
I mean, so I wouldn't say so. So what we mean by this, okay, is that in capitalist societies, okay, the driving factor, the thing that drives competition. So one of the main things that makes businesses more competitive is technical innovation. So therefore, technical innovation is a huge component of capitalist competition, and therefore of market development, of in general the economic development. Okay, technical innovation. And technical innovation increases the amount of constant capital that is employed in production. Constant capital refers to the machinery, refers to the raw materials, refers to raw materials, and also refers to the tools that are used in production. And normally machinery is more costly, so therefore it increases constant capital, right? And so having more machinery, etc. And since, okay, these things, when they are accumulated relative to the amount of labor that is actively being used in production, when they get accumulated, they increase the denominator of the rate of profit, of the function of the rate of profit. And what they do is basically they make slowly the rate of profit fall. So the insight is technical innovation without any big changes in the rate of surplus value, in the rate of exploitation, brings about a slowly lower and lower aggregate rate of profit in the aggregate economy.
So, and what social forces are keeping the sell price from raising to accommodate the raising denominator? Like what then is keeping them from going, okay, well, if the rate of profit is falling, I will simply charge more?
Well, it's primarily competition. So obviously, in the short run, maybe, okay, as a business, you can obtain a short run extra profits from raising your price. But in the long run, which is what we are interested in, okay, by raising your price, you're shooting yourself in the foot, because at some point, new competitors are going to come that are going to drive you out of business by selling at a lower price. Okay. And why do they sell at a lower price? Because if you're selling way above your cost, another person is not going to do that. It's going to sell closer to their cost, and therefore it's going to drive you out of business, right? So that is really the force that makes it so that in the long run, things cannot be compensated in the way that you're proposing.
This is a difficult sell for me, because I'm thinking, and maybe I'm not thinking big picture enough. I can think of examples for and against this happening, right? I know there are industries where an expectation for technological innovation increasing means that eventually the margins get narrower and narrower. Like another example of this that I can think of would be the margins for airlines. It's not a commodity, it's a service that's being sold, but much in line with the same kind of logic, you know, airline prices are really low, and airlines now run at like exceptionally low margins to the point where they basically rely on subsidies. There are actually a lot of industries that rely on government subsidies because on their own, they're not capable of sustaining the expected price point, which kind of suggests that like the rate of profit fell below negative for them. And the only reason they continue to exist is through like government intervention, as opposed to them just raising their prices. Like the meat industry is heavily subsidized, but the meat industry couldn't just raise its prices because if it did, it would cripple like a ton of adjacent industries, like fast food, for example. And then that would raise, and then everyone would kill themselves. So instead, the government steps in. I can think of examples there where it's like, yeah, somehow, like, in spite of the greed of corporations, the rate has actually fallen below par. And that's one thing. On the other hand, with inflation being what it is, and a lot of that inflation being really arbitrary on the part of corporations just like raising the price of milk or whatever, it seems like sometimes they can get away with just like, if they want to, they can just up the line, and that would keep them from ever falling below like the red line of the rate of profit. I can see how that would be a tendency in the long run. I guess that'd be like a long-term empirical thing. I've seen people argue that there's empirical evidence that the rate of profit is falling, and I've seen people argue the opposite, that it's not. I think it's interesting to think about. I'm also going to be super rude and cut off my rant here because I need to pee. 1 second. Give me a sec. Talk to chat.
Yeah. Well, I'm not. I don't have chat right in front of me. Let me just get it in case. Okay. So it's loading up. So how is everyone doing? I cannot read anything in chat right now because for some reason it's not popping up. But okay, now I can. Anyway, I hope you are finding this conversation interesting. I know all of the stuff here is a little bit too technical, and depending on how far you want to get into the subject, it might actually just be very boring. So I understand that it's probably very boring to a lot of people. But, let me just say as a pitch that it's really interesting to know these things for political purposes as well. Because I know a lot of people here are really interested in political discussions.
I made it. I'm back. Okay, so after all that ranting, was I anywhere in the ballpark with that? Or am I broadly describing like individual instances of the rate of profit adjusting based on material conditions?
Yeah. So you introduced an element that is really important to keep in mind, which is the fact that market economies are not like isolated from state intervention. Actually, in capitalist societies, from the very beginning of capitalist economies, the state has been involved in the regulation and in the forwarding of certain market forces in a very strong manner, okay, in a really strong fashion. So you just touched on something that is really important, which is the fact that there are some external stuff to the inner mechanism that I was describing that, in a sense, make the outcome that I'm describing the real outcome deviate from the one that I'm describing. So what my contention is that with the law of value, okay, what we are working toward is a theory of the inner mechanisms of market economies. And when you introduce, and surely for analytical purposes, you must introduce higher stages of analysis where you include things like the government, like even like natural disasters and stuff, which are really important. But what I was describing to you was really an internal mechanism of the functioning of capitalist economies. Okay.
I thought of another example. I totally get what you're saying too, but even without government intervention, right? Widgets. Okay. Everything in our economy is made up with widgets. Like every bit of technology, every coffee machine, every little thing that you build is actually constructed of 1,000 other things made at a bunch of other factories. And you can imagine a widget, let's say like I don't know, like a basic like mechanical thing, like a hinge, right? Hinges are used in everything, you know. Factories don't build their own hinges if they want to make a product that has one. They buy them bulk from another company. Hinges are used everywhere, absolutely everywhere, in everything, and they're cheap too. So the problem is, like, if you have a billion industries that rely on constant cheap hinge production, right? Like, there might be internal mechanisms like competition that would drive the price down, but you can only, like, you can only innovate on a hinge so much. There really is like a floor in terms of like how efficiently can you produce hinges. There's a limit on that. And once you reach that limit, like you have one pressure, which is the capitalist like competition for the lowest price of production, kind of running up against a wall. And what you might eventually run into is that now there are like huge market incentives for the production of hinges at cost, at which point like the rate of profit is null. It no longer exists, you know? I think there are examples of this, of like the cheaper and cheaper production of certain types of like tier one tech widgets it gets so low that there's actually like economic turmoil in factories that produce the basic building blocks of all of modern society, which is insane because you'd think they would be like so stable, right? Like you'd think something that produces hinges would be like a really stable like production line because everyone needs them. But in reality, the economy is inefficient here. It's actually irrational. It doesn't allocate its resources effectively. And for that reason, you actually get a negative incentive against those initial building blocks because they're far enough down the line that everyone just expects really cheap production. You know what I mean? Like that. So that's an example that I would think of, I guess, because I read a thing about that and how you have like factories that can produce 1 million billion things a year and still somehow be like running up against financial troubles. And that's when subsidies tend to come in. And then and that's why like the low wages Walmart pays its workers get subsidized by the state through like welfare systems. It's every time there's like an inefficiency that doesn't properly allocate resources under capitalism, there has to be something underneath it holding it up. And in this case, it would be the state. And all those like little inconsistencies, if addressed fully rather than being subsidized, would be like, oh, wow, maybe the rate of profit is falling in some of these places. Maybe we're running up against like an internal contradiction, you know? Is that, am I anywhere near?
I think that you did a really nice description, okay, from a very Marxist perspective. Okay, I'm really proud of exactly the thing that I want to describe.
Gold
so
star.
it's the fact that there are these internal mechanisms of capitalism, okay, that drive capitalist economies to trouble, to economic trouble. Okay, they drive them to economic trouble, and then in order to get away from that trouble, you need external intervention. And where does that external intervention come from? Well, things like the state and so on and so forth. So what Marx really wanted to do in his critique of political economy was say, look, yeah, a lot of the things that were said by the classical economists are really correct, but let them be more correct. Let's take it to a more correct, even to a higher level of correctness. And if you find yourself at that higher level of correctness, suddenly you get to the conclusion that capitalist economies are not all nice and beautiful and maximizing everyone's utility and so on and so forth. Suddenly what you find is that capitalist societies are turbulent, that they are characterized by constant conflict, by warfare. You know, economic warfare is a huge way of and a very damaging way of attacking your competitors. And even if you see this in the dialectic between countries, you can see also economic warfare being, the cause of deaths and a lot of very, very big issues. And the thing is, what Marx really did, and this is the really why it's useful, okay, to have this framework that I'm laying out to you, is because suddenly you can make sense of a lot of the things that before, with the neoclassical from the neoclassical and the Austrian perspective, you couldn't actually make sense of. Suddenly you start to see conflict not as an exception to the rule, but as part of the natural functioning of society. Suddenly you see economic crisis not as, oh my God, is this external thing that suddenly happened and we don't know why it's there and whatever. No, suddenly you see economic crisis as an internal feature, as a fundamental aspect of capitalist economies. Economic crises are the way in which capitalist economies progress to different stages. Okay, and you see this throughout history. You see how through economic crisis there has been a change in the face of capitalism. But a change in the face of capitalism doesn't imply a change in the inner mechanisms of capitalism. And those have remained almost intact from the time of Marx. This is why when a lot of people say, why should I read Marx? Isn't this, like 19th century stuff? And it's not useful for today's world, whatever. No, it actually is, because yes, capitalism has changed its face, its makeup a lot from that time. But you know what? The inner mechanisms of capitalism haven't changed that much. Surely there have been a lot of improvements, for a lot of changes. For example, we moved from commodity from commodity money from the gold standard to purely fiat money, and that brought into the picture this concept of inflation, which was studied but from a completely different perspective in the time of Marx. So Marx, I don't know if he would have been able to conceive of the kind of inflation that we theorize about today. Because obviously he had a theory that, and actually modern developments of classical and Marxian theories on inflation have actually produced a theory of inflation that is developed specifically by Anwar Shaikh, which is an economist that I take with a lot of regard and that I looked up to. And this theory, okay, takes all of those insights and produces a theory of inflation that explains really well today's kind of inflation, the kind of inflation that is related to fiat currency. We can also understand one thing that we can understand really well, for example, that in neoclassical economics is not well understood, and there are many ad hoc theories of imperfect competition that are brought about in order to explain this phenomena, is unemployment. Think about something so fundamental to capitalist economies as unemployment. And think, how can a neoclassical economist conceive of unemployment? Well, under perfect competition, they can't. So they need to include, market frictions and all that. And those are interesting, but those are really, and I have studied them with a lot of detail from economists that are amazing economists. Okay, one of the economists that I work with in NYU is called Guido Mencio, and he specializes on market frictions and all that. And those models are really nice and really, mathematically they're really beautiful, but they ultimately don't give you the kind of answer that you're looking for. Why unemployment is prevalent in capitalist societies, and what explains the levels of unemployment today relative to the levels of unemployment in a different time period. Well, in the Marxist framework, we can explain this. Okay, and the theory that we work with is the theory of persistent unemployment. And it is also related to the thing about profit, but I want to let you talk a little bit first because...
Yeah, as I understand it, that frictional unemployment, the idea would be that you have like a small buffer of unemployed people, which promotes the it promotes the power of the capitalist, because it means that if you ever lose your job, you know that you'll be entering a sea of people who are desperate for work. And it means that if a job ever opens up in a business, they can usually fill it pretty quickly, which is pretty evil, conceptually, that would be something you have to accommodate for. But I guess thinking about it, that is pretty specific to the current system. I don't think frictional unemployment was a thing in feudalism. I don't think that concept could have even existed. I think if you were unemployed under feudalism, you just died, but also no one could really be unemployed because there was always something you could do, right? There always. I can't imagine, unless you were crippled or something, which, I mean, obviously not to say it was an equitable system under feudalism, but I think no matter where you were, there had to be work somewhere. That's just not the case anymore, especially not with rising standards of customer service, presentability in the modern system. I'm not sure.
Well, back in feudal times, employment didn't work in the same way that it does today. Okay, it's a little bit like how wealth, people labor in some cases in similar manners. Okay, but the labor adopts a different social form. Where in the case of capitalist economies, employment is wage labor, whereas in feudal societies, employment was done through, you are attached to the land that you are born in, and therefore you have to work in that land because that's where you were born. And that is the social status in which you were born, and there is no or very little mobility from there, And so employment work in a different... Actually, I wouldn't even call it employment. I would just call it, feudal labor. I would call employment the wage labor that is a characteristic of capitalist societies. But if you notice here, unemployment in capitalist societies has a very specific role, which is the role of disciplining labor. Okay? It is the discipline that is put on labor in order to drive their wage share down and in order to bring profitability upward. What do I mean by this?
Good question.
So within this theory that I'm working with, okay, total output is divided between wages and profits, okay, and at a very simple level, okay. So then, what if suddenly there are some factors in the economy? So what if suddenly the workers, for example, have more bargaining power, and they're able to obtain a higher share of that output. So they're able to obtain higher wages. Well, that means that profit has to go down, because it is an identity. It has to go down necessarily, unless, okay, obviously you can include certain things like, what if because wages are up, productivity increases? Well, I'm just saying, like, ceteris paribus, again, like keeping output constant, higher wages implies lower profits. Okay, keeping output constant. So
yes.
Then what is the implication of this? What is the implication of this? Well, we made workers better, but what happens? Profit is lower now. And what happens if profit is lower? Profit is what drives investment in capitalist societies. Profit is the driving factor of investment, and it makes sense because profit is the leftover, right? And what does where can investment come from, other than from the leftover, from anywhere else? It has to come from the leftover of what you already produced. So therefore, and this is why normally, like when a company makes profits, a part of it goes as dividends, okay, to the stock owners, and then another is rediverted into investment, is rediverted into the production process again, right? The reason for this is because capitalist economies need to keep growing in order to, and businesses need to keep growing in order to stay competitive. If you as a business are not growing, so sooner or later you're going to find yourself in big troubles. But the thing is, the key insight is, well, now if investment slows down, then accumulation slows down, productivity, so production slows down. And what happens if production slows down? That there is less aggregate demand. And if there is less aggregate demand, then there's going to be a lesser demand for labor, right? There's going to be a lesser demand for labor. So then, now the workers lose that bargaining power, and now what the workers find themselves in is a situation where their wages are going to be pushed downward. So therefore, an initial increase in the wages of workers in the long run produces, well, in the long run, like after a certain set of steps, actually produces a decline in their wages. And actually, this decline is done through unemployment, through leaving, a lot of the working positions that were there before idle, so that now this is like straight market economics, like supply goes, so like the demand goes down and the supply stays more or less constant, so therefore the price goes down.
Okay, so to run this back, what you're saying essentially is that with regards to unemployment in the current system, these constrictions of labor power and increases in unemployment or decreases in wages, they can be a product of like exigent forces, because since these systems require constant growth, because shareholders want to make returns on their investment, meaning that a keeping the same market value is not acceptable to them, they'll always push for constant growth, which is bad for its, for a variety of reasons. But that can mean that there can be constrictions of the productivity of a workplace that have nothing to do with the actual production in and of itself. That the external labor forces, because of the way we demand constant growth, are sufficient to cause these constrictions and therefore decreases in labor and therefore broader market crashes, depending on how far it goes, through something that has literally nothing to do with the actual like productive output of a company. It's entirely divorced from it, at least in concept. It can be, and this would be bad, as I understand it.
You put it very in a perfect manner. I think that you got the idea very well. It's and you know what the political implication of this is? Think about it. The political implication
is completely broken.
Yes, but you know why? Because making workers' lives better ends up making their lives worse. You know what I mean? Through this mechanism. It's like, yes, as leftists, we want to make worker conditions better in capitalist economies. What is the downfall of that? That it reduces profitability. Of course, sometimes, okay, and as I was saying, there can be increases in worker welfare, and at the same time, because there's higher level of output, then that doesn't imply, okay, as I was saying, this decline in profitability and therefore decline in investment and therefore that. But when profitability starts to get constrained by the increases in the well-being of workers, then economic growth decreases. And when economic growth decreases, there starts to be, business crash, aggregate demand falls, and there's less demand for labor. And there's less demand for labor, there's less demand for consumer goods. What happens? Suddenly the workers lose that welfare that they gained.
Yeah, this is why like having a good CEO doesn't matter, right? People talk about, well, how do you make capitalism more ethical or whatever? What if you have like good people on the board? The problem is, like, if you're a public company, the people who buy shares in your company are the people who buy shares in your company. You don't get to choose the ethical ones. And the stockholders require constant improvement in the investment. They require the value of the company to go up no matter what, meaning that any effort to make the conditions for workers at that company better, which will invariably come at the cost of some degree of profitability, because you know that's where wages come from. It's going to cut into the rate of return, and therefore, like, there's a market disincentivization against systems like that, even if all the internal corporate culture is like really friendly and ethical. The only like workaround you could get, the only times you could get mutual benefit, there are some instances, I think, where you can have improvements to the lives of workers that that also improve like corporate productivity. Like, for example, OSHA. Having a simple system for workplace safety has massively cut down on workplace incidents, which also cuts down on the amount of lawsuits and on workplace turnover as people lose their arms and stuff. So that that'd be a rare example of like mutual benefit. But the majority of the tension in terms of like worker attainment and their wages and everything is a direct push and pull for resources with corporate. And as long as that is a system that's ultimately dictated by the whims of structures that benefit the needs of shareholders, there's no way for any kind of long-term like worker benefit to last, really, outside of like direct government intervention.
Exactly, and that is why gains today in labor power in capitalist societies are always under threat of being torn down. Always under threat. So the simplified version of this argument is profitability and worker well-being sometimes go hand in hand, but not necessarily. There's no strict logic that says that when profitability goes up, that necessarily implies that worker conditions and happiness also increases. In fact, a lot of the time, they don't go in the same direction. They go in opposite directions. So what this means is that you have a system that is incentivized and that it is driven by profitability, not by worker well-being. And worker well-being sometimes is aligned with profitability, but not all the times. Actually, a lot of the times it's not. Therefore, you don't have a system that works for workers. You have a system that works for profitability. And that explains why workers are not the ones that benefit a lot of the time from the good outcomes of capitalism, but nevertheless are the first that feel the pain when capitalism doesn't do good, when the capitalism fails, Yeah. And then that is why you also need a state. Not only the state to come in and protect businesses from failing and all that, but also the state has to be there to stop workers from rebelling too much. Just enough, but not too much. And this is why, especially
well, we're seeing
in the
this
US,
right now with Biden's administration shutting down the rail strike. Yeah. Where like, yeah, even then it's interesting. Then it's kind of funny because you hear libertarians talk about how everything would go so much better if there wasn't a government to interfere with business. But in reality, government intervention is the only reason capitalism like props itself up at all. Because all these market inefficiencies and like internal agitations would have already led, like everything would have fallen to pieces already if it wasn't for like a non-profit oriented system stepping in and like kicking them in the ass now and again to try to like keep things in order. And that's not an argument in favor of capitalism with government intervention. It's just like the bare minimum is kept together, with scotch tape and like glue, with like an external system. And there's not really an example of that never like not being needed. Those company towns that were founded out west fell apart really fucking quickly back in the day.
Yeah, and notice that what we are just talking about is the critique of social democracy.
Yeah. No,
so
yeah,
implicitly,
fully.
We haven't been saying it, but implicitly we have been critiquing social democracy. And we have been doing so in a fashion that is not a moralistic fashion of, oh no, because social democracy is not aligned with the true communist purpose of worker solidarity and that. No, we're critiquing it from an internal mechanism of these types of societies that says, yes, you can benefit workers all you want, that if you keep the capitalist system in place, sooner or later, those improvements are going to be torn down. And what is even worse, that is actually going to, sooner or later, bring them to a point where they may be actually worse than before. Not just that they're going to be at the same level, but sometimes even worse. So worker conditions are not necessarily going to, in the long run, improve.
And even if you have like a fully sympathetic government, even if you have a bunch of Marxists running a government that is social democratic in nature, ultimately, like, because your interest is to the common good, there are limits to how far you can push workers' rights, because the system within which you're doing it is always going to teeter back. Like, if you push too hard, and you see this all the time, even with like mild social democratic reforms, right? Where even like tiny pushes on corporations to incentivize like mildly better behavior, you can hear people talking like, oh, okay, well, if they go a little bit farther, like, this is all going to collapse. There's just a limit to how much they can do within the system. Their morality doesn't factor into it. Same as a CEO, you know? At the end of the day, it's the shareholders that make the shots.
Exactly. And so then the key question, is then how can we solve this problem?
Suicide
how can we
pact.
go beyond? How can we go beyond that? And that is a socialist question, that is the question that we ask ourselves as socialists is, well, how can we actually improve upon this? But we do so from the acknowledgement that these types of societies are far better than what we had before in most cases. And actually on the acknowledgement that they are, they are good at what they do. They are good at technical innovation. They are good at, increasing production a lot. Okay, so you see, an over accumulation a lot of the times of a lot of goods, but they're not good at everything. They're not good at making human lives necessarily better and for a sustained period of time, and everyone's lives better. Okay, because yes, maybe and this is really important question when you look at international trade, because you see that some countries are very wealthy and others are not, and actually you can explain that by saying yes, because the wealth of the rich countries a lot of the time is premised upon the poorness of the other countries, and you can also understand this through the lens of Marxian and classical political economy.
Yeah,
so then the big question is,
Qatar. Qatar is a perfect example because they have a very high GDP per capita, but they also have like 10% of their population as actual citizens, and the rest of it is like slave labor they pull in from other countries. There's always an external cost. Under the system, there's no way to get something for nothing. Everything has to come at the expense of somebody somewhere. Some countries internalize it and some externalize it, but it always comes from somewhere under capitalism.
Yeah. So then how can we improve upon this? And then, you have a lot of answers to this. But, I think that surely what we need to keep in mind is, first of all, we need to understand everything that is useful from the system that we currently have, everything that is good from the system that we currently have. And you say, well, because it incentivizes innovation and all of that. And that is certainly good. I mean, it's at least better than not having innovation, But then the thing is, how can we make it better? And I would say that we can make it better by, in principle, okay, by making the system so that it's not driven by profitability, but that it's driven by human and by worker well-being. And then the question is, how do you do that? How do you derive a system that is driven not by profitability, but by human welfare?
It seems like the first step would be getting rid of the shareholders, right? Because every problem we run into keeps coming back to private ownership of corporations.
Yeah.
I mean, well, that's why I hit on the worker cooperative market socialism angle, right? The logistics of dismantling a for-profit economy, really complicated, big brain stuff, not for me. However, there is a meaningful difference between like a democracy and a monarchy, right? I think that if you scale things back, there's no real reason why we need to have a stock market. It's not inherent. It's not like the concept of investment can't exist without it. Investment as a concept has existed for all of human history. without the need for a stock market, without the need for like shares or whatever. It seems like that'd be the first kick, right?
Well, I mean, within the context of capitalist economies, the stock market plays a crucial role, and it is really important.
But
But
like
that is within the
inherently.
context. Exactly, but that is exactly. This is the thing: is that within the context of capitalism, yes, it is important, but it is not necessarily important if you move beyond capitalism. You can have a system that doesn't have a stock market, and yet still produces a lot of the outcomes that we want to see. Okay, and again, how can you do this? Well, one of the things is, you just said it yourself, getting rid of private property. And this is the fundamental socialist and communist position, right? Getting rid of private property. And how do you do that? Well, I mean, worker democratization of the working place. And then the question is also, how do you do it? Do you do it how long will it take? Will you do it immediately? Will you do it in the long run? Will you remove private property in some industries, but not in all? You know. And then another thing is decommodification, not just removing private property, but also removing the commodification of the objects of social use that are in our societies. That is also a principle that I would say it's a socialist principle that can move us to a better system. But then you can get lost in the details, right?
Well, I want to get lost a little bit. The problem that I'm having here, you know, we've got two great problems of our time. One of which is that we live under capitalism, and the other of which is that it's been 90 minutes, and I'm actually running up against stream time, and I have to do some other things. Are you free tomorrow evening? What time zone are you in?
Well, I'm in Central European time because I'm in Spain.
European, you're European, that's right. Fucking Euros. I would like to have you on again, this time in a much like shorter time frame. I just have to finish some stuff up before stream ends. I know that I started late because I overslept, but
Oh, don't worry.
would you do you think we could talk next week for sure? Dependent.
Yeah, I
Would that
mean
work?
next week. Next week it's like I'm gonna work a couple of days during the week, but for the rest it's going to be primarily holidays. So I can give as much time as you want to a conversation, whether it's half an hour or an hour or however time you would like.
Okay, then okay, for sure then. Can you send me an email, like I guess as soon as we're done talking, so that I can like remember to look at my schedule and see what time I have?
Sure. I just say that around 9 p.m., 10 p.m. In Central European time is the time that works normally best for me, but not all the time, because obviously when I have to go out, with friends and whatever, it's
Right. Yeah. We'll work something out that works out for both of us. I
okay.
didn't mean to cut you off there or anything. I just know that I'm running scant on time. It's been a delight to talk to you. I look forward to finishing the conversation.
Yeah, for sure. It's been also a delight to talk to you, and hopefully the next conversation will reconsider if you are being convinced by the theoretical framework that I laid out to you. But in any way, it's been really a pleasure to be with you and your audience. I see a lot of very kind comments, and
a lot of thirsty ones too. Yeah, it's no, it's been a delight, and I've always been interested by these theories. It's more to do with like their defensibility, which I try to. I try to focus on like the easiest angles of approach. I feel you can usually get people in the broad strokes with some fairly intuitive sociological arguments, whereas getting in the nitty gritty of the econ stuff can be a bit more difficult. But it's still helpful to know, and I'm happy to have the opportunity. Thank you.
the good thing is that they're really defensible theories. Also empirically, which we haven't get to the empirical part, but they're empirically very defensible as well.
If you know them. I appreciate you coming on. Can you shout yourself out one more time?
Yeah, so my name is Victor Magariño. I have a YouTube channel that has my name, so it's not that hard to find it. I mean, you just have to spell my name, which is probably the harder part of it. And I talk about political economy from a classical Marxian perspective, and I'll be very happy to entertain any questions or anything that you want to give to me there. Okay.
Pleasure's mine. You take care, and I'll talk to you soon.
Sure. Okay.
Well.
Goodbye.
Bye. That was fun. Yeah, a lot of interesting stuff there.